Hello, everyone. My name is Brittany Button, and I'm a long-term care insurance specialist for Art Jetter and Company. Thank you for joining us on this highly anticipated presentation from Securian Financial. Now, we're joined by Tim Go, Regional Vice President for Securian, and today we want to help you have more productive long-term care planning conversations. Truly, we hope this helps you uncover more clients in your own book of business. But before I turn it over to Tim, I just want to mention that if you have any questions throughout the presentation, please type those into the chat box on your screen, and we'll make sure to have those addressed by the end of the presentation. Also, we have some handouts available for you, so take a moment to save those for your review. Tim, without further delay, I'm turning it over to you.
Awesome. Thank you so much, Brittany. Like she said, my name's Tim Go. I am based out of the Minneapolis area, and I am the Midwest Secure Care RVP covering Art Jetter. And today we're going to talk about how to present a long-term care solution to a client. Now, if you're new to the conversation, I know it can be a little intimidating to know how and where to begin. So this presentation is meant to give you a rough blueprint for how to present a long-term care solution to a client. So presenting a long-term care solution, it can be a challenging proposition. The reality of aging, and especially the need for care as we age, is tough for most of us to think about. Now, a successful long-term care planning conversation acknowledges the risk of not preparing well for a possible elder care event and focuses on the possibility of designing the best or ideal outcome for our clients should they experience an elder care need. Now, we boiled this down to a simple four-step process. One, help your clients understand the basics about why long-term care planning matters. Fact find to understand their needs, address client concerns, and present a solution custom fit to address their situation. Now, helping clients understand why long-term care planning matters, it's a broad topic that can cover a lot of ground, but you'll likely want to steer the conversation to two main points. One, the risk of needing care, and two, the impact long-term care expenses can have on income. Now, how you approach these 2 points, it can depend on your position. If you're introducing the topic of long-term care planning as an insurance agent, you might focus the conversation on the risk of needing care and how you can help protect the client from the impact of that risk. Now, if you're a financial advisor, you might explain that your role is to help ensure the client has the best possible income or investment outcome, and long-term care protections can help put the client's portfolio in a more favorable position. Now, regardless of your role, every plan starts with the vision for the future. And for most clients, one of their main financial goals is to plan for retirement, allows them to live their lives to the fullest. Now, this can involve setting financial goals to be sure that they're able to live the life they desire, or they may have personal goals like traveling, spending more time with loved ones. They may recognize their retirement income and savings may need to last 20 years or longer. Now, most clients plan for phase one of retirement, retiring from their workplace, creating a lifestyle for their time, traveling, golfing, shopping, joining clubs, etc. And many of us anticipate and plan for the income needed in this phase of life. Clients frequently don't plan for phase two of retirement, phase that is often called aging in place. This is when clients start to slow down and may need assistance and help with tasks around the house. They may even end up needing help with everyday activities of living. This phase of retirement may require additional income to support these added care costs and medical costs on top of the lifestyle income clients had planned for and still need. There are a lot of different ways to articulate the risk of needing care. Now, some folks use statistics and studies like the average lifetime cost of care and how many adults will likely need care as they age. So for proponents of this angle, we have a What's Your Care Plan infographic tool, which can be a great asset for you. It highlights key statistics that you can use to help steer clients towards understanding why long-term care planning matters. For other folks, the best way to talk about the risk of needing care is by telling a personal story about a loved one's experience with aging. I'm sure you either have had a long-term care experience with a friend or a loved one, or know friends or loved ones that have experienced a long-term care event. Telling a personal story is the easiest way to gain, common ground for a long-term care story. Some of our most successful producers, they use a combination, of course, of the two approaches. When you can contextualize facts with the personal story, you can help clients begin to make the connection from, well, that's just something that happened to someone else, to, hey, that's something that can happen to me. However you choose to focus the conversation, there are a few key notes you're going to want to hit. Now, making a plan, it's not just about planning for if the client gets sick. It's also about planning for longevity. The longer we live, the greater the likelihood we're going to need help as we age. Medicare doesn't pay for most long-term care expenses. In fact, it doesn't pay for any long-term care expenses after 100 days. Medicaid only kicks in when your assets are depleted, and it typically only covers facility care. The cost of care is rising, and you as the advisor or agent, you can localize this to the client by pulling the average cost of care in their state and comparing it to the future. And to top it all off, there's a current and projected future labor shortage in many care sectors. So preparing for it now is top of mind and prudent to really put your client in the best position possible. Now, once you've established the risk of needing care, the next step is to connect that risk with the client's own retirement income. Now, envision one of your baby boomer clients with a typical retirement portfolio. Maybe they have a small pension, some cash or investments set aside, and a majority of the retirement savings in a 401k and an IRA. This client's 401k and IRA forms a bucket of money saved for retirement. And their retirement income is a planned stream that they're relying on to pay for their living expenses. Now imagine they live into their 80s. They need long-term care, and they're now solely dependent on the same bucket to continue providing needed income, plus additional income for assistance or care. This double tap bucket is now pouring out two streams of income, and they may run out of money faster than anticipated. In addition, they'll be planning for care with taxable income. Their opportunity to have the type of care they want may be limited, and any legacy they intend to leave behind may be in jeopardy. So, how do you understand your client's needs? Among respondents to the 2022 Insurance Barometer Series, that's a mouthful, the reported rate of long-term care ownership rose from 15% to 18% in 2020. Now that represents a 20% increase in 1 year. In a 2022 survey, 60% say they need long-term care insurance, which suggests the COVID pandemic raised the perceived need for long-term care coverage. Consumer interest in long-term care planning, and I'm sure many of you are experiencing this in your day-to-day, it's increased dramatically, especially in recent years. You have the impact of COVID, shortage of caregivers, state, federal legislative discussions around consumer unpreparedness, and your client, they may have some interest, but maybe they haven't had the opportunity to talk to anyone about it. So effective fact-finding for long-term care planning will be centered around four main questions. Where do clients want to live and receive care? What do they want? Who do they want to provide care? What are their wishes for the care they receive? And how do they plan on paying for care? Now, we have two pieces to help with this. First, we have a long-term care chronic illness quick questionnaire. It's a quick, easy way to open the conversation and help clients begin to articulate their future long-term care plans. Now, our second piece is a worksheet that guides clients through the process of how to create a long-term care plan. The worksheet is designed to help your client take a closer look at each of these four key questions. The goal of this planning piece is to get your client to think at a deeper level about what they really want out of this stage of their life. So let's take a closer look at this worksheet. There are several factors to consider when answering questions like, where do you want to live? This part of the planning process, it's important for families to think through and evaluate what their desires and what they want. How can we design a plan for spouses to stay together or family to remain close? What living arrangements or amenities are crucial for their lifestyle? Do they want to prioritize staying in their house? What would downsizing look like? The worksheet helps clients begin to think through who is going to be involved in their care. And as we age, our mental faculties inevitably may begin to deteriorate. Who are the key parties clients want to identify for managing care, mediating family and loved ones' concerns? Who's going to help them with their medical situations, care for their home, manage their finances? Should the clients engage a power of attorney, identify a qualified geriatric care manager, or identify a trusted financial professional, maybe like yourself, to help manage their affairs? Of course, what does the dream plan look like? Help your client paint a clear vision of their desire and goals. Right? Is this plan, desire, is it written down on paper for loved ones to have? You should encourage them to engage with their spouse and their kids or any other interested parties in this vision at the very beginning. Let them voice their concerns or be a part of this process and get them on board and make the dream a reality. Now, after you've got a handle on your client's needs and wants, the next step is helping them look at their retirement assets to decide what assets they're going to use to make their plan possible. Now, after evaluating the assets and income that a client may have available to them, like now or in retirement, you want to calculate the risk of not preparing for care costs. Will their projected retirement income support their lifestyle, plus an extra $5,000, $10,000, $15,000 monthly in additional care costs? What would that do to their retirement assets or plan? What would that do to their legacy and what they intend to leave behind for their kids or grandkids and charities? Even for folks with significant wealth, it's important for them to be conscious of where their assets are held. Would they have to liquidate investments or holdings? Right? Would they be drawing from taxable sources? More than likely, there's a planning vehicle that would be a smart investment for them and potentially put them in a more tax-advantaged position for funding care costs. Now, going through the fact finder with your client, it'll help you develop a clearer picture of their future goals and concerns, and understanding their goals will help you make a recommendation, but understanding their concerns and making sure you address objections, now that's crucial to making the right recommendation. So before you go through any recommendations, you check in with the client, make sure you're meeting any objections. And one of the most important parts of this entire process is to cement in the client's mind that this is a joint plan, not just something you're selling. This is a partnership between you and them. And addressing any objections is how you can best accomplish that. Now, we have a piece called Overcoming Objections, and has some of the most commonly laid out objections. And we've included some possible responses to them. I won't go through all of these for the interest of time, but I'll kind of give you a couple, right? One is, I don't think I'll need care. My mom, my dad, they died at age 65, and I'm probably going to croak right away without needing long-term care. And you probably want to ask them or say and acknowledge, yeah, you're right. You may not live a long life or need care, but if you do, you should consider the consequences to your family. In addition, you may want to ask your clients how long they expect their retirements to last. A lot of people have their retirement portfolio to pay out until like age 90 or whatever age they specify. So then you can ask them, well, why do you need your retirement to go that long if you don't expect to live that long? You may get the objection, I don't want to involve my children. I'll take care of it myself. Of course, you can say that their children love them and you want to make sure that they're well taken care of. And you as the planning agent and the advisor, you probably have seen firsthand how beneficial it is to have children involved in the beginning in any financial process, especially this process, so that they're informed of all the desires and decisions and are ready in the event of a long-term care event. So now you want to solidify their plan and you want to make it a possibility. So in discussing and recording their long-term care plan, it may be prudent for them to think through several what-ifs and have planned accordingly. To help your client develop a good, a better, and a best plan depending on what happens next. What if they are diagnosed with Alzheimer's? What if they have a debilitating stroke? What if they live a wonderful full life and they just need help with their activities of daily living? You want to discuss the intentions and the plan with family members, and you want to review wills, trusts, powers of attorneys. You want to identify key parties. Who's in charge? Who's managing their care? Is it a geriatric care manager? Who's mediating family and loved ones' concerns? Is it a spouse or is there a child designated to take lead? Who's managing finances? Is it an attorney, financial professional, authorized to help? You want to review solutions to make whatever care plan they decide possible. So you can ask, what are the solutions designed to help? And can we create additional income to make our best plan possible? Can insurance protect us enough to ensure we can implement at least our good or better plan? And are there safety nets to make sure we don't run out of money? So I want to take this time to review some potential solutions available to clients, right? So traditional long-term care insurance, you may be aware of, it tends to be, in the past, budget-friendly because they're really focused on long-term care, right? You have multi-pay options, and you can have shared care for partners, but underwriting can be pretty arduous. Premiums are typically not guaranteed, and a lot of times it's a use it or lose it type of scenario, right? So you want to keep this in mind as you go through this plan. Short-term care, right? It's not as available. Products are available for older, maybe less insurable individuals, but of course it's a very short period of time, limited type of care, and it's not available everywhere. Life insurance with accelerated benefits, right? Hybrid. You have this, and you can compare this with linked benefit. Typically, these life insurance with accelerated benefits is a acceleration of the death benefit. There's no inflation protection, but you retain liquidity and flexibility from the life insurance portion, depending on which type of policy you have. Annuities with long-term care riders, right? Huge pro here is you can use qualified monies. Easier to qualify because it's an annuity, right? But oftentimes you need that lump sum funding, and most of them are a reimbursement model, if not all of them, with elimination periods. Then you have your life insurance and long-term care hybrid products, which is really where the marketplace is moving towards for individuals looking for comprehensive long-term care solutions. These products will typically offer multiple guarantees, from guaranteed death benefit, long-term care benefit, return of premium, etc. At least Securion's hybrid product is a qualified long-term care product, so you get some tax breaks and opportunities that way. But it can be limited from a payment structure, right? Short pays and non-qualified funds. So there's no one true perfect solution, which is why the solutions-based process is critical for you to go through and then backfill a solution from there. Lastly, I want to just address the self-funding, right? A lot of times you'll have wealthier clients and they'll say, well, I have the assets to self-fund. Of course, they retain liquidity. It's flexible, but the big thing here is tax timing. The consequences of this are massive. You don't get insurance leverage, right? Most wealthy people use the leverage to their advantage, and that's oftentimes how they become wealthy to begin with. So definitely want to recommend at least looking at leveraged options. So let's dive deeper into the whole why consider insurance over self-funding. So when you're looking for an option that kind of really helps support, protect this vision, we're biased, but we definitely see hybrid solutions as providing a very, very good plan for middle to high income clients. And one of the reasons for that is you can use a hybrid solution to protect a portfolio of assets by leveraging liquid dollars. So this is how that can work. Let's say you have an individual, Dana, who's worked and saved over the years, and now that she has a retirement portfolio that can generate enough income to cover her living expenses, she can enjoy this next stage of life. But what happens if Dana's health declines? Her income will need to cover her living expenses and her care expenses, and if it can't, she's going to have to take out more money than her portfolio can replenish, or she's going to have to make some tough decisions about the kind of care she wants to receive or change her lifestyle. So by reallocating a portion of her portfolio into a vehicle that can protect her savings and retirement income, she can essentially create another source of income she can draw from if she becomes chronically ill. This is that tank of water with two spigots example. So how can we replenish that water that's coming out? In addition, qualified long-term care insurance solution, it can create a tax-free benefit or income stream to use in long-term care, helping to create a potentially stronger tax advantage position to a portfolio. So we have a video that walks you through this. We also have pieces and worksheets for you and your clients that you can go through line by line to help them plan and kind of put pen to paper for this. With that, all of our marketing material, you definitely want to leverage Brittany and ArtJetter. We also have a non-password protected site on securian.com/long-term-care-social-social. And I'm going to give you some time back. These presentations typically take a half hour, so want to open this for questions. Brittany, if you want to jump back in.
Of course. So yes, we actually had a few questions, comments come in during the presentation. So for those of you on the call, if you are unable to see where the handouts are or they're not downloading for you, simply throw our team a note at ltci@jetter.com or call into the office. We can definitely send the attached handouts that Tim actually went over during the presentation. We can get those in your hands via an email. So again, if you weren't seeing that but wanted those, just let the team know. All right, let's see what we got for questions here. Ooh, here's a good one. I'll have you kick started off, Tim. We've got an advisor asking, what would you say the common client looks like who is buying Securian Financial's Secure Care 3? So what's your average case design? What common age are they? Are we gender specific here? Who would you say is the ideal profile for Secure Care 3 directly?
Yeah, so Secure Care 3 is currently really well priced and really targeted towards that common long-term care age of anywhere from 55 to 65. So that's where we're seeing the most interest. 60 is our average age. Middle to income individuals, about 60% of our cases that we see currently are single pay scenarios, and about 35% are 10 pays, right? So we're seeing this number shift, especially as these types of products are being presented to more middle income individuals that want to utilize a longer pay, but it's very, very popular for single pay scenarios. And to dive even deeper, from a case design standpoint, our two most popular durations are 4 and 6 years, and a 3% compound rider is typically what's used. So that ripe target age for long-term care of 55 to 65, typically affluent individuals, targeting short pay, 4 to 6 year duration, 3% compound is our most common design.
Awesome. And I guess me personally, I'm going to nerd out a little bit here on long-term care insurance. Do you see a good amount of folks utilizing a small 1035 exchange, say from a small existing life insurance policy, but then adding the ongoing premiums of, say, 10 or 15 years on top of that? Is that a common practice you're seeing?
It is. So we released Secure Care 3 about 2 years ago, and with the price changes in the marketplace, we really took off last year. And one of the new features with the product, with this iteration of the product, is exactly what you're talking about, Brittany. It's being able to get a 1035 and then add on a premium payment schedule on top of that. So we are seeing more and more of that. Typically, it results in a 10 pay. But yes, it's a very popular choice, especially if you have a smaller 1035.
And just on top of that, I ask because I'm seeing that case design start to pick up as requests. And, we're talking a $35,000 or a $42,000 1035 exchange. The client or policyholder is no longer needing that specific life insurance policy, and they're more gearing towards that long-term care planning scenario. So for those of you on the call, think of individuals you may have in that exact situation. So, Tim, if this next few questions, if you could go back to your slides talking about the different types of long-term care insurance solutions. Got to make a few comments there.
Yeah.
So, first and foremost, well, let's stick with the annuities with the LTC riders for now. So, this can get slightly confusing in our industry. you're going to find that there's hybrid long-term care insurance / annuities, maybe fixed. I know there's a couple indexed out there. You're going to find those styles underwritten. They're going to require the long-term care CE certification, which is actually the next question coming up. And they're still going to provide a tax-free benefit when your client goes on claim. That should not be confused with other styles of annuities out there. There are annuities, primarily what we call indexed annuities. They're based on market performance, where they'll involve an income rider. That income rider is designed to provide lifetime income during retirement, which is a lot of people's concerns. Some of those income riders will have features, likely at an additional cost, that will double that monthly income stream for maybe 3 or 5 years if care is needed. Now, those can be a great solution when your client's primary need is retirement income and long-term care insurance is secondary, or for those who simply may not get through any medical underwriting whatsoever. But you've got to keep in mind, those additional, that bump in payout, that's taxable income. That's what those annuities are designed for. So we're going to see those be slightly different solutions when we're taking a look at those. Do we want underwriting? Do we want a tax-free benefit? What's our primary goal here? And then just recently, Federal Life came out with their My Immediate Care Plan. Now, I actually just sent out an email today on this to the database. It's a newer product out in the market. It's a SPIA. It's a single premium immediate annuity. Now, it is underwritten, but it's underwritten to provide a larger income stream for those already needing care or getting ready to enter some type of care situation, whether it be home care facility. That is still just an annuity. So we don't have the long-term care CE requirements, and that is enhanced income. So we're looking at that as a taxable income stream coming in. So the annuity world is getting very creative out there. There's a ton of newer solutions. So we had somebody ask, just wanted to pinpoint there are differences between those styles within the annuity world. All right, so next question, CE certification. I simply like to think of it like this. If it provides a tax-free long-term care benefit, long-term care CE certification is more than likely required in your state. Now, not all states. New York does not require it for their standalone products, except for they have some other stuff they require, Reg 187 and product-specific training. Also, I believe, what's a couple other ones that don't? Connecticut really doesn't have the CE certification unless it's partnership qualified. They get kind of in the weeds with that one. But your short-term care, these annuities, just enhancing income, those aren't going to require the long-term care CE certification simply because it's not considered tax-qualified long-term care. So if you're wondering if you need the certification, again, call our team. Our contracting team's great. We can look up most CE transcripts in most states. We can definitely tell you what the state requirements are. Okay. Tim, maybe not. If you can answer this one, we've got somebody. I think somebody has a client on the mind. They're asking what condition or what reason does Securian decline most on? So are you seeing a lot of people just simply not looking at height, weight, not disclosing during the personal health interview? Kind of what's your top declines you're seeing out there these days?
Oh, that's such a good question. And
I know. It's all you.
I don't think there's any one condition, right? I mean, typically, so I will say first and foremost, we have a very good pre-screen process, a good pre-screen team. I know Brittany utilizes it quite often. If there's any medical history whatsoever, I recommend utilizing that team, and we'll follow up with that information because they'll recommend you move forward with an app or not. They'll also give you a pre-screen code which you can attach to the app. You just put it in the agent notes, and they will link that pre-screen to the underwriting. It always helps from a due diligence standpoint. But I don't have a single top decline. Oftentimes I'll see people who've recently had a surgery or they have upcoming procedures and they move forward with a long-term care application. It's typically not a great idea for long-term care. Or there was a recent, I've been seeing more and more, hey, I had surgery 3 months ago and I'm recovering, but that's still so soon that hard to give a decision right now. Then oftentimes the underwriters will say, reapply in 6, 8, 12 months, right after the surgery. So if you do have a client in mind and they have a medical history, use the pre-screen team, utilize Brittany and our Jetter, and I'm a resource for that as well. We can look at specifics.
And that would have been, if I was just me on the call, that would have been my same comments. We have Sean Whittington here in the office. Some of you have probably spoken to him. He's our in-house underwriter. He can shop that around. And even if Securian says no, which we don't like to hear, but it happens, if they say no on a particular client, Sean's more than happy and will shop that around with our other carriers, our other solutions to show you where that client specifically could get considered for coverage. So it's very informal. It's valued client, male, 58. Here's what's going on. So Securian or any of the other carriers, they don't have a client name. They don't have a date of birth. We're all keeping that very HIPAA compliant. And I would say even broadly on the desk, it's exactly not necessarily declines. We're seeing a steady stream of one specific thing. It's the surgeries and physical therapies. If they have something pending, or I'm in physical therapy, or I just got done with physical therapy, we're typically looking at a postpone anywhere between 6 to 12 months. And I stress that because we've had a postponement. The guy was getting physical therapy on his shoulder. And I kind of take a look at it. If it was myself, I'd be like, well, what does my shoulder physical therapy have anything to do with long-term care? Because he didn't indicate it on the app. And I understood. I wouldn't connect a shoulder sprain or injury that I'm clearly going to recover from having any impact on my underwriting for long-term care insurance. But it does. It's simply a postpone, but let's, not waste your time or the client's time and do our due diligence up front before we're filling out that application paperwork. All right. Well, Tim, I think that wraps us up for now. Of course, if y'all think of any other questions or just want a one-on-one with a member of our team, let us know. We're standing by. We can be reached at 800-228-0008, or again, drop us a note at ltci@jetter.com. I want to thank everyone today for taking time to join us. Tim, thank you for co-piloting today's session. And with that, enjoy the rest of your day. Thank you.